Hey guys, welcome to Market Mondays. Hopefully you had a great weekend. We're going to talk about why interest rates being high is actually a good thing for the housing market. We're going to be talking about a few updates on what's happened with inflation, because that's a really big piece in regards to what's going to be happening next year, as well as far as unemployment rates also rising, also further reinforcing that we're going into a recession. So before we get started, we got to do a dad joke, right? So, our first dad joke. Oh, I remember I said. So, uh, did you guys hear about the race between the giraffe and the ostrich? I heard it was neck and neck. Neck and neck. Get it? Haha. Alrighty, so getting right into it. So before we talk about why the high interest rates being good for the housing market, we're going to go into some details about inflation. So inflation readings came out last week, and there's two types of inflation readings that we look at. One's called CPI and one's called PPI. Um, we don't have to get to too many details, but CPI is what the government likes to look at, and PPI is just another version. CPI in that inflation reading, it's actually gone down from 9.1 to 8.5%, which is a really good sign. Inflation's curving. Also, it's reacting to the Fed raising the Fed funds rate, or the Fed's hiking rates. This is a really, really good thing, especially because if the Fed funds rate goes up, inflation comes down, so will mortgage rates. Another thing to reinforce that inflation is the other reading that we talked about, which is called producer price index inflation reading, or PPI. That went from about 11% to about 9.8. Sorry, I want to make sure. Yep, 11.3% to 9.8%. Again, these two readings show that the trend of inflation is coming down, and that is a response to the Fed hiking rates, which is, again, a very, very important fact, which means that mortgage rates are expected to come down later in the year. So they are responding to the Fed taking action, and that's what's important. If they weren't, then we have a huge, huge problem. The next time the Fed is expecting to hike rates is in September. They're trying to get an idea of what the August inflation report would look like, which just came out, and they're looking at the employment reports that are going to be coming out in August as well. And depending on those two things, they're going to decide how much to hike the Fed funds rate in September 21st in that meeting. So between right now, it's leaning toward a 0.5% hike or a 0.75% hike. So either way, if they do hike it, again, further reinforces that mortgage rates will come down later in the year and into the 2023, which we're all really excited about, right? Another thing to kind of note is that the unemployment rate. Right now, there's about an additional 14,000 people who have filed for unemployment, right? So this is actually the 4-week average is about as 262,000 people have filed for unemployment benefits over the last month, right? So, and these numbers haven't been we haven't seen these numbers since last November. So and one of the things to kind of note is that a recession, one of the indicators for a recession is that unemployment rate at its lowest. It's kind of weird. Well, you would think unemployment rate at its highest would be a sign of recession. Actually, it's when at its lowest. It's because all these corporate companies, what they do is they hire a bunch of people, and they realize their overhead shot up, and with everything happening, and they can't continue to pay these people and make all their payments for expansion, they have to lay off a bunch of people, and then that's what happens when we go into recession, especially when inflation's dropping. So unemployment rates at its lowest is a sign of recession moving forward. Of course, all of these people are getting laid off is not a good thing, but it is a sign that recession is coming. So that's a really big important piece to know over the next year. Um, this is the recession, or sorry, the unemployment rate will continue. People filing for unemployment will continue to go up. So now we're gonna get right. We're gonna show you guys the charts in a little bit, but let's go into why high interest rates is actually a good thing for the mortgage market. So if you've been in the market for about the last 2 years and you just owned a house, or your client owned a house, you all saw, for most part, nationwide, between 15 to 20% appreciation every year for the last 2 years. That is insane. For any kind of investment, 15 to 20%, even 25% is really, really high returns. It really is. It really big returns. It usually requires a lot of risk and a lot of time to make sure the risk is as mitigated and calculated risk as much as possible. In this case, all you have to do is pay your mortgage and just own a house. You saw 30 to 40% appreciation over the last 2 years. So That kind of appreciation, rate of appreciation over the last 2 years is unsustainable because it will just continue to get. Imagine every year your house, increases in value by $100,000. And imagine those people who are trying to save up for a 400,000 house, but next thing you know, by the time they do that, they're now paying for a 500,000 house. That's insane, right? That's too much. So what's happening with these, and the reason why the appreciation has gone up so high is because of supply and demand, right? Not only do we have too many people shopping, we just don't have enough inventory. Between those two things, those are going to shoot up home prices. Well, with the higher interest rates going up, it's gonna sadly, but it did, this is what happened is that it pushed a lot of buyers out of the market, which reduced the demand. The supply stayed about the same, but as long as demand kind of started going down, now we're seeing something really different in the housing market that in the last 3 months compared to what we saw in the last 2 years. We're seeing opportunities to get seller concessions. We're seeing price reductions all over the place. So that's what a lot of people are doing now. And now it's starting to shift into more of a buyer's market because interest rates have caused the demand for buyers to go down a little bit because it priced some people out, which is a good thing. Again, now we're seeing homes in Washington State. Now we're seeing homes that are easy that can be bought under 400K. We didn't see that for a long time. And we're not seeing just a few homes. We're seeing dozens of homes. So this is one of the best times to buy a house. And those people who can afford the house and can take that interest rate being higher are going to be ready when interest rates drop next year and be able to buy a house. Or sorry, be able to refinance and get up that lower payment. And they would only be in that high interest rate for such a small amount of time. So for the most part, it is a good thing that interest rates went up. It's like I said, all this stuff is all about balance. If we saw really, really low interest rates and, home prices, go up. So for a time, for about a year and a half, a lot of people were buying big homes, bigger than they would ever thought, because interest rates were low, but home prices still steadily went up. And then all of a sudden it shifted completely to a point where home prices continue to go up, and so did interest rates. Well, at some point, something had to something had to break, and it was interest rates, and it caused interest rates to go up so high to the point where people couldn't afford these homes. So it priced some people out, and then home prices started going down, and interest rates effectively in the last about pretty much throughout the summer have plateaued quite a bit. So let me kind of show you a chart in regards to seeing what interest rates have done since basically May. So I'm going to share my screen real quick. I'm going to show you guys what has happened. Again, this is a Google generated um, chart. So there's no advertising, there's no marketing, there's no paid advertising on this. This is an average, true numbers of what mortgage rates are actually doing right now. Again, this is an average. So if you guys know how an average works, you take the high number, you take the low number, take all those numbers in between, and divide by how many rates you're getting. And this is a pretty accurate in regards to what mortgage rates are doing. Obviously, there's rates that are going to be lower for some companies, and some rates are going to be higher. Just depends on the situation. So in order to get an idea, as a person who's trying to get an idea of what your client can qualify for, at least conservative, you just go to Google and type in today's current mortgage rates. You can scroll down and then you can, for the most part, this section over up here doesn't really matter too much, but it gives you a baseline of what's going on. They may change by an eighth of percent for the most part, but these are the things I'm looking at: 30-year VA, 30-year fix is conventional, and 30-year FHA. There was a post like 2 weeks ago by AOL or something like that, which is weird. I don't know why AOL, America Online, has a news reporting website that goes over mortgages, but they're making a report like, oh, mortgage rates are under 5%. The only mortgage rate that was under 5% was the 15-year rate, and most people aren't even really going to go into the 15-year rate. So, but all the 30 years are around 6% right now. And you can kind of see over the last since May, things are kind of plateaued a little bit. They haven't risen like they were between December and April. They've actually plateaued quite a bit. And this is a good sign that the Fed hiking the Fed funds rate is working, causing mortgage rates to curve quite a bit. So try to inform your clients that, hey, this is a temporary time. This is a time to um, you know do your best, as far as like and being prepared for being able to refinance next year. So again, this is a tool that you guys can use. Go onto Google, type in today's current mortgage rates, and just take a look at the trend. Again, you can see how volatile it can change every single day in regards to mortgage rates. So I know that was a lot, but hopefully you guys got a lot out of it. Hopefully some of it resonated with you. If you have any questions, let me know. Otherwise, nuke out.